Good afternoon, everyone. Welcome to today's weekly market insights. Now, as we have a look across to the calendar, not really much to go off in terms of data releases. Pretty choppy trading conditions over the course of this week, with it being difficult to pinpoint one major theme across market participants' minds. Now, we had a couple of speeches out of Jerome Powell this week where he did allude to the fact that the Fed may be open to hiking interest rates by 0.5%, by 50 basis points at their May meeting, which is in fact their next meeting. So it remains to be seen how that plays out over the coming weeks. It will be interesting to hear other Fed speakers' rhetoric when they decide to come across the wires. Will definitely be something we need to look at. With there being potential for 7 rate hikes over the course of this year, be the potential for 200 basis points for rate hikes. That is 2% increase in the interest rate. In America, it's a lot of hawkishness that there's potential for over the course of this year, but all of that hawkishness has been priced in. I mean, this is known to markets over the last 6 or 8 months that this was the route that the Fed were going to have to go down to tackle this inflation that has been caused by unprecedented amounts of monetary stimulus, low levels of interest rates. Providing support to the economy to help pay for these lockdowns, help pay for these restrictions across the globe, and help try boost markets and also boost the economy. Now, the result of that has been record high levels of inflation, which we all know in markets, the levels of inflation are at record levels, and something has to be done to counteract that, and that is to hike interest rates. Now, how much interest rates are hiked remains to be seen going forward, but with the potential for 200 basis points worth of rate hikes throughout the rest of this year, it is something we are going to have to take very seriously going forward. Now, we had some positive PMIs out of Germany yesterday. Again, positive data out of Germany, but does it really matter? In my opinion, markets are probably more focused around the situation of what's going to happen in regards to the Russia and Ukraine situation, which has again intensified this week. We've had peace talks, again to no avail. They don't seem to be doing anything. Personally, I don't see the point in these peace talks. There's clearly not a willingness to back down. And we also had the headlines over the course of yesterday that the US and NATO were preparing for nuclear warfare, which is not a good thing. Obviously, you don't need me to tell you that, but in terms of moving forward, if that is something that ends up happening, we've got to think it'd be at the impact of markets, and that will certainly be a negative for markets. You'd imagine stocks would sell off heavily, bonds would be bid, and your safe havens would be bid. So something we can definitely look towards going forward, but for now that's just a theory. There's big headlines on Bloomsbury making a big deal out of it yesterday, but I think we would need some more information on that before markets start moving. So not a lot in terms of the calendar. We'll come across to the charts and have a look at the charts, but again, not a lot to go off. In terms of themes this week, for me, something I was paying attention to this week and certainly today was the S&P 500. Now, the S&P 500, if we look at this weekly chart, this big bullish candle of last week, followed by another bullish candle through this week. It is the first time that the S&P 500 is going to post weekly gains back to back over the course of this year. So to me, that is a positive for stocks. We looked at a daily, and this moving average that we've got on is the 200 daily moving average, which we have managed to get back above over the course of this week and the back end of last week. We also look towards the VIX, the volatility index, a kind of fear gauge for the S&P 500 for stock markets, and that is now back below 25. Clearly this move downward has continued over the past kind of 10 days, and that is largely for me due to the fact that the whole situation regarding to Russia and Ukraine. Previously markets over the first kind of few weeks of that, markets would react to these negative headlines. Anytime we saw a negative headline, markets would react. They would sell off, and markets were very headline driven. Over the past of 10 days, I think we have moved back to sort of more normal trading conditions. In my opinion, the bulls have wrestled back control of the stock markets, and we have continued higher over the course of this week. So For me, obviously we got the underlying hawkishness from the Fed, the hiking of interest rates throughout the course of this year, but that remains to be seen how much of that is already priced in, which a lot of it will be priced in as it was known to markets ahead of the time. Yes, so for me, in terms of the Fed, for stocks to continue lower from here, for the dollar to continue higher, I think the Fed are going to have to come in over the top and surprise in terms of hawkishness, which, can I see happening? I don't know. Even that 50 basis point rate hike in May seems, potentially kind of overcooked, if you ask me. But we will have to see how that plays out going forward. Certainly a 25 basis point rate hike, I think, is a certainty. Whether we get that 50 basis point remains to be seen. But we will need to pay attention to the rhetoric. Now, the potential for fast interest rate hikes has done to the bond market, as you can see here, this is the spread between the 5-year and the 2-year back here. This is the spread between the 10-year and the 2-year. Both of these are we can see across the board the curve has been flattening over the last number of weeks and months. Since October back here, we've been trending lower. Really we kind of a bit of a double top here, but we've really been moving lower over the course of the 5-year, 2-year spread. Since October, we come towards the 10-year, and we come back here. We've been trending lower really since April across this. So that's long-term bond yields rising, or short-term bond yields, rising faster than longer-term bond yields. That is, historically, that has been a indication of an impending recession. So, this fast interest rate hiking cycle by the Fed could potentially cause the yield curve to invert, which would be a negative for the economy, negative for markets, and is something that we're going to have to look towards going forward. They either accept that, or they risk inflation getting out of control with the rising commodity prices. So I think a lot of it depends around the Russia-Ukraine situation, whether commodity prices pick back up and continue to rise, or that starts to cool down and markets start to look past this. I think a lot of the jitters in the first month of the Russia and Ukraine situation was that we would experience a full blown global recession, which would be a negative. So fears of that have certainly subsided over the last kind of week. So not a lot to go off this week, not a great deal to go off. We'll come across to the calendar and have a look at next week's data. Pretty quiet start to the week next week, but we do have NFP back end of next week on Friday. So we have inflation figures out of Europe. We've got NFP next Friday, and we have got also manufacturing PMIs out of America. So beginning of the week, we can see how we've got as a speech out of Bank of England's Governor Andrew Bailey. We've got retail sales out of Australia on Tuesday, and then once we get into the back end of the week, we start to pick back up again. The clocks change, so we lose an hour of sleep back here, but the market opening times in the US will be back to normal for us here in the UK next week. Pretty, slightly difficult video this week. Not great trading conditions. FX pairs have struggled to move, apart from that dollar yen, which has been on an assault higher. Which at the moment, I suppose saying no signs of slowing down until today. We did have a bit of a move lower over the course of today, which is a bit of a pullback. But it's just that sort of moves. We'll have a quick look here. USD JPY. I'll get that up, and you can see the speed in which we have moved higher off the course of this. I mean, this has got all the makings of a move that has gone too far too quickly. This is a move in relation to the US 10-year yield, where it correlates quite highly, that I've spoken about in different videos. US 10-year yield over the course of today has hit 2.5%, the highest point in 3 years. We have to go back to we've got to go back to May of 2019. What's back here? Sorry, May of 2019. Since we have hit these sorts of levels. So dollar yen is likely to be most affected by this, just simply down to the fact that the Japanese 10-year yield is anchored at 0% with the Bank of Japan's monetary policy situation. And with the US 10-year yield rising faster, it makes the US dollar a more attractive proposition. But this has been a global rise in bond yields across the board. So the yen has weakened across the board, which has exacerbated that move to the upside in dollar yen. So as long as this continues to move higher, we would expect some more weakness in the yen. The Bank of Japan are somewhat powerless to do anything about it, and that can provide us with some good trading conditions over the course of the coming week. So we're going to need to find some direction. We're going to need to find a theme for markets to follow and see if we can follow that. Remains to be seen how that plays out. A bit limited in terms of fresh news flow to give these markets direction. You've got to look towards our technicals and the way that and cross asset correlations to see if we can pinpoint some direction off the back of that. In terms of headlines, in terms of data releases, we've not got a great deal to go off. NFP, as I said, back end of next week, definitely worth a look. And that's all from me then, folks. I'm gonna wrap it up there. And have a good weekend. Still sunny here in London. Hopefully it's sunny where you are. Get out and enjoy yourself over the weekend. Enjoy some time with some friends and family. Or if you enjoy being alone, enjoy that too. Well, that's it from us then. And we'll be back next week for another weekly market insights. Thank you.